We'll title
4
it
people.
Season 2.
Yeah.
Sweet. And then when you don't have 4 people, then I will have
Your setup. Yeah, perfect.
Yes, and you need a microphone next time. That's perfect for season 2.
That's what he said.
Oh, that's what you just said?
Yeah.
Okay.
Right.
I thought he was talking about the 4th.
We're active listening.
I'm not.
I know.
We know. Let me just tell us.
He's
all right.
listening to prep what he's about to tell you next.
Quick, Cohart, can you give me your most enthusiastic, I'm Chris Cohart, and welcome?
Yeah, I'm Chris Cohart, and welcome.
Ooh.
Beautiful. Love it.
Oh, you were
Love
just
choice.
about ready to introduce some smooth jazz on
I
that.
was about to say, I got my Hennessy right here.
Yeah, I was thinking about the. I was thinking about that SNL
Easy
character.
listening to Richard Marx.
What was the Saturday Night character?
Ladies' Man.
Ladies' Man. That's what I was thinking.
Courvoisier.
Yeah.
No, is that what? Yeah.
Yeah.
It's not Hennessy. It's Courvoisier.
Courvoisier.
One more time, Cohart.
Oh, I don't think I can duplicate that again. This is Chris Cohart, and welcome.
Oh, now we're at a talk show.
Yes.
Now you're about ready to give me love advice.
It was just a little bit hot. Okay. All right. I'm
Wow.
gonna go.
Just
That's what they always say.
just a little bit hot. Not like really hot, but just really a little bit hot.
I know. We need to start using some of that. Footage.
Yeah, that's what my wife says all the time.
Not really hot. Now Paul Rudd, that motherfucker.
Like, okay, there's Brad Pitt with you can't ever say once Brad Pitt and George Clooney are still alive that Paul
Rudd is the
somehow,
hottest
yeah,
now.
like it just
No, he's just like he's
He's the-
age defying.
He's the ageless wonder. Yeah.
yeah,
Yeah.
he's gotten better looking as he's gotten older.
You realize I
Yeah.
haven't done the intro yet, right?
Oh.
So we're clear. Save this stuff for the podcast.
All
He's
right.
gotten much more attractive as he's gotten older. but
Yeah, absolutely.
he's still no George Clooney.
no George Clooney.
So for today's episode, we're
We're gonna discuss whether people's sexiest man alive is appropriate.
That's true. This is a cold
Yeah.
open. All right.
Yeah, there you go.
Enough of the sexiest man alive. You missed it. Welcome to the Trust Us, We're Professionals podcast with your friends from SSC, CPAs, and advisors. This is a podcast where we break down financial matters found in pop culture. Basically, we make complex financial matters more consumable for our listeners. I'm your host, Chris Underwood, a financial advisor with SSC Wealth, and I'm once again joined by Chris Cohart and Michelle Hammond. How are we doing?
Excited.
Did you know that Paul Rudd went to the University of Kansas?
Yeah.
Like sexiest man alive, Paul Rudd.
Didn't graduate though, right? Like a year? Someone
Many of us don't.
For the record, Michelle did graduate.
Yeah.
He's in a large group of people that went to the University of Kansas for a hot minute.
I know, but we're trying to sell ourselves as trusted advisors here. I just want you to know.
Well, then we probably shouldn't have named the podcast what we did.
Fair enough. All right, loyal audience, you are in for a treat. We have a special year-end tax planning episode for you today.
No, don't leave. Don't change the channel.
Yeah, I heard
That's a good one.
applause. I heard cheers. Heard excitement.
Go get your popcorn.
PJ
And-
immediately fell asleep.
Yeah. And we did our best to find a pop culture tie into year-end tax planning, but yeah, we couldn't do it. So our
Nothing.
goal with this podcast is to take that really boring letter that CPAs and financial advisors send to you and make it much more meaningful, right? Make it clarify it for you.
Our pop culture connection right now is that Michelle's wearing a Notorious B.I.G. hoodie. So we're pop cultured right now while talking about tax.
Yep, brought my Big Papa shirt today.
Yeah.
So, you know.
And that fits in.
You have to bring a little bit of gangster energy when you start talking about year-end tax planning, right?
Right. It's more pop culture to wear it than to not wear it. So
There you go.
Fair
So I
enough.
feel like we did our job. We did what we told the listeners we would.
Absolutely, we always deliver. Let's start with what's changed, because that's obviously what people want to know. What's changed? Let's start there.
oh,
So
geez.
much. I know. So let's talk
Yeah.
about what we know for sure.
I go night-night.
Yeah.
Yeah.
Yeah, we'll wake you when we're done, Underwood. No, you always usually have some really good questions. It's like you get a free tax planning session out of this. We're going to talk about small businesses. PJ has one, so
Mhm.
feel free to raise your hand if you have any questions. Okay, so we're going to talk about what we know that has changed for sure. So the first major change in 2021 was the American Rescue Plan Act. And this is passed. This isn't up for debate anymore. Chris, do you want to talk about some of the things that act did for individuals?
Yeah, there's a lot, but the biggest thing that I think a lot of people felt was the economic impact payments. So there were 3 sets of economic impact payments. 2 of them we've dealt with already. I'm sure everybody knows their tax preparer emailed them or called them and said, "How much did you get in your IEP payments?"
Mm-hmm.
Well, and your response was, "I didn't know that was taxable." And definitely not taxable. We just have to reconcile it. So you got 2 of them, one in 2020, one in the first part of 2021. That was all part of the 2020 return. And then you would have gotten a third one starting in the middle of March. And we'll have one more reconciliation to do on the 2021 payment. So that one was a $1,400 per individual and then $1,400 per dependent on your return as well. So your accountant will email you again this year. How much of the economic tax payment did you get? So we can reconcile that on the return.
Because if they didn't get it and they should have got it, it's calculated on and included then on their
Right.
2021 return.
They get a credit on the return.
But if you tell me you didn't get it and you actually got it, then you're going to get a letter back that says that I messed up your tax return with that
Yeah,
information.
we got a
So
lot
it's
of
really
those
important,
letters.
right?
We got a lot of those letters this
Yeah.
year.
And it's going to be super confusing because people also started getting payments for the child tax credit advance payment thing. You want to talk about that?
Yeah, that one's a little bit more complicated even. So a lot of folks who had their kiddos, they were getting the child tax credit. They expanded the qualifications, but then they decided to go ahead and do advance payments on that. So starting in the summer of 2021, you were getting advance payments on the credit based off your 2019 or 2020 return. Some of those are checks. If you filed your return and you had bank information, then you would have gotten direct deposits. The deal with this is we have to reconcile that the same way with the economic impact payments. The difference being if you got the economic impact payments, but you shouldn't have, or your income for 2021 ended up disqualifying you for the EIP, no repayment. That's just free money.
So if you didn't
You're welcome.
file,
Free money.
so if you purposely didn't file your taxes, knowing that your income jumped, you don't have to pay it back. Like let's say 2019.
Yes. So if you had not filed your return before they had calculated the EIP payments, I don't want to say intentionally didn't file it.
He's asking for a friend.
Yeah. His name is Bliss.
If your 2019 income
Overwood.
was
Over concrete.
was lower than your 2021 income was going to be, and you hadn't filed it before the payments went out, yes, you would have received a economic impact payment where maybe you didn't qualify for that on your final 2020 return. So
I'll let Bliss know that.
yeah, but with the child tax credit, there's a reconciliation just like the economic impact, except for there is potentially a repayment on that credit.
So it's really important to go back through 2021, write down the payments that you received so that we can use that information to get your 2021 return correct.
Right. And what a lot of people don't necessarily realize is they've been getting that credit on the return, which has been helping with their tax liability and potential refund or smaller balance due. Well, now that credit they're getting in advance, so it's not really going to be a credit on their return.
Are you telling me my refund is going to be less, Mr. Cohart?
It potentially could be.
Okay, just remember
Yeah.
we told you that in before the end of the year. That was your warning, guys.
Yeah.
That that was a pre-refund of your refund.
Right. And there is some repayment protection rules. Essentially, if you make over a certain amount but under a certain amount, then you would phase into that protection. I think it's $60,000 up to $120 for married filing joint. That if you make less than 60, there is no real repayment rule on that. But if you're over that and under the 120, there's probably going to have a conversation. If you got the advance, now you could have gotten one payment. You had the option to go on the IRS website and tell them to stop giving me the advance payment. I don't want the money. I want it later. But not many people did that.
Yeah, I can't imagine.
So
Okay, so one of the other good things, though, with the act is the charitable contributions. So it used to be that you couldn't take charitable contributions in excess of a certain percentage of your total income, right?
Yep.
And now they say 100%. So all of your charitable contributions, right? If you itemize.
Close.
Our deductible.
You're really close.
I feel like if I
You were
make
so
a
close.
statement, right?
Yeah.
And you could just say, Michelle, that was good enough. I
know.
wouldn't pay you your full hourly rate for that,
Yeah.
but maybe $50.
You were probably 90% of your billable right there.
Okay, perfect. Hit it.
So you were really close. So
Mhm.
a couple changes, like Michelle said, there was up to 60% of your AGI that you could use for charitable contributions in the previous year. That's moved to 100. If you didn't itemize, you could take a $300 deduction against your adjusted gross income. This year, they're moving that to $600.
Nice.
No big deal, no change. Where we're slightly different is on the 100%.
Mhm.
It has to be cash contributions.
Oh, why do they put
contribution.
stuff in there like
And
that?
it can't be to a donor advised fund,
Okay.
can't be to a supporting organization,
Okay.
can't be to a private foundation. So there's some, as with every law, it seems like there's a little bit of a, but you've got to really dig into the note.
I was mostly correct, PJ.
Yeah.
Don't you feel like I didn't address specifically you can't dump off $200,000 worth of stuff at Goodwill.
Yeah.
Right.
Right.
Okay, but
But the
cash.
donor advised fund is a big deal.
It is
a
because
piece of
people
that.
use that for a lot of planning.
Yeah, with the increase in the standard deduction, we've seen a lot more people, and we've advised a lot more people to look into those donor advised funds as an option to get full value for their charitable contributions in 1 year when they're all under the itemized deduction limit. So that it kind of takes out that as an opportunity to advance some charitable contributions you may have wanted to do in that year because it wouldn't necessarily qualify for the 100%. You can still take the deduction. It would be limited to the 60% of your AGI, not to 100% of your AGI.
Okay. But if you want to give it to the places that you usually give and you had a big taxable income year, it's time to do some charitable planning, right?
Yeah, the church needs a
Fair
new
enough.
building. This is a good time to do it because you can do up to 100% of cash. Now, you want to, if you don't have the cash on hand, a lot of times people look to sell their stocks, and you're going to have to take that into consideration of what the tax ramifications of getting the cash on hand in order to make that sizable contribution. And it might be the right decision.
Yeah.
But you'd have to do some serious planning to make sure that ends up with a tax benefit to you.
Yep. And then last year we were scrambling because they made unemployment compensation
Oh, yeah.
not taxable to a certain extent after we did a whole bunch of people's tax returns who all had unemployment because who didn't have unemployment for a hot minute, at least in 2020, right? So what's that look like for 2021?
That looks like it's not even consideration.
Okay, for now.
Yeah. For now. That's right. Yeah.
Be a real kick in the nuts if they did it in 2022, maybe in March, made it retroactive again or something like that.
Yeah. They've never done that in the past.
Just once. Okay, so last
Just a
year,
couple times.
now your unemployment that you got in 2021, it's all taxable.
All taxable.
Okay, perfect. And then RMDs, required minimum distributions. So these are for our retirees.
Yeah. So this was not part of the American Rescue Plan Act. This was actually part of the Secure Act, which changed the RMD requirements from 70.5 to 72. And there's even a little bit more stipulations to that. If they were 70.5 before 2019, then there's a certain amount of time in which you had to take the RMD, and after, it's quite.
So you should just ask.
Yeah, I should really ask.
If you're about 70 and you're taking stuff out of your
what
retirement plans.
I think the interesting piece of this, because in what was part of the American Rescue Plan Act was that you could defer those RMDs.
Mm-hmm.
So some people didn't take the RMDs in 2021 because of the American Rescue Act, but now they potentially would have two that are starting in 2022 that they potentially would have to take because of the new Secure Act RMD rules.
Mm-hmm.
So, and everybody knows, not everybody knows, but most advisors know that those RMDs and making those things is really important to do those in the right time, because the penalty on not taking RMDs got to be the worst penalty. Really close. I don't know which one's worse, but
I mean, death maybe.
tax penalty.
Tax penalty.
I mean, that's a 50% penalty.
Yeah.
By not taking, even missing it by a day.
Yeah.
So if you delayed that, you skipped your RMD payment in 2020, and you're now part of the new Secure Act RMD rules, you really need to have that conversation with your financial advisor, your CPA, to say, what's my RMDs going to look like? Do I need to take one this year? Do I have two coming in 2022? Really starting to plan that out and make sure you hit it the right way.
Yep.
So you don't get hurt too much. Also part of the Secure Act that kind of went under the radar because the American Rescue Act was so significant, was the inherited IRA rules. In similar to the RMDs, there's some timing issues. If they were 70.5 before they passed and 70.5 after they passed, when that RMD has to start coming out and when you calculate it. And most people know when you inherited an IRA that was non-spousal, you could stretch that IRA out over your life or over the decedent's life, whichever you wanted to do, and they've limited that. So now it's a 10-year window. So you can't go any further than 10 years on that inherited IRA. So have to start really planning that out. If something happened in 2020 where you were able to not have that RMD, because maybe your father passed away and he passed on the RMD, now you potentially have a pretty quick turnaround of when you're going to take that out.
Yep.
And this is why planning is so important and why we're doing a year-end planning episode.
Yeah.
Yeah.
See, so fun. No, it's so important because when you take that required minimum distributions are taxable.
Right.
If you have a lot of big ones in 1 year, you end up in the next tax bracket. So it's you've got to be able to plan it out, like you said.
Right. And we also had the remember we were able to take out money out in 2020 from people's IRAs without penalty, and then you could either potentially repay it or you could just pay tax on it over a 3-year period. So a lot of people did go ahead and defer and take 1/3 of that income in 2020. Maybe they forgot and they were doing this other planning and they have another third payment that's going to come in 2021 and maybe 2022. Or maybe things turned around and they got in full employment and they need to go back and look and see, well, maybe I should just go ahead and repay that full IRA withdrawal. And then you get complicated. You got to go back and
go there.
You got to amend the 2020. Let's get boring.
Yeah.
Let's just fall asleep.
Yeah.
Listen to this calm, soothing voice of amending returns.
And here's how you amend a return. No, we're not doing that. Okay, what about there's stuff about businesses in the American Rescue Plan Act?
Yeah, there was a lot.
And it's confusing. We won't tell you how to do a payroll tax return for the employee retention credit, but I think it's worth mentioning, right?
Yeah, it's definitely worth mentioning. I think that was PPP was a huge economic impact and pushed forward a lot of businesses and saved a lot of businesses over the last 18 months, 19 months. But somewhat overlooked in that process is the ERC, the Employee Retention Credit. It didn't get a lot of talk in 2020 because if you got PPP, you couldn't get ERC or the ERTC. Well, the Appropriations Act at the beginning of 2021 changed that, and they went back and said, no, we're not going to do that. You can get the ERTC in 2020, even though you got PPP. So it opened up the floodgates. Not really floodgates. It was a small.
I would call it was a flood. I mean,
Yeah.
we had a lot of people who had previously taken the PPP loans,
Right.
and then also met the qualifications for the employee retention credit, and we're having to really do a dance of
Right.
how do we maximize those things.
Right. And 2021 was much more impactful, even
Yeah.
though 2020 was impactful because they moved it from a 50% of 10,000 per employee per year to 70% of 10,000 per employee per quarter. So you get 5,000 per employee for all of 2020 or 7,000 per employee per quarter for the entire year.
Those are big numbers.
That's a really big number.
Yeah.
$28,000. I mean, we did some that were pretty.
My biggest was $656,000 for one quarter.
Yeah.
Not me personally, the client. I didn't get the 656, but it was really important for them to help keep their business afloat. Actually,
Right.
Yep.
I know we did a couple for a few nonprofits and they didn't realize it was there. We were keeping an eye on where their revenue stood and the grant money wasn't available that they hoped they were. And this money really helped them keep the doors open, keep moving along.
I'm a small business. I haven't taken the employee retention credit. I haven't thought about it. Just start, gathering my quarter on quarter sales
Yep.
and call your accountant and just make sure you don't, that you didn't qualify for it. You think that's probably the best advice?
I think so. Yeah. It's not that hard to. I mean, there's a lot of rules that relate to it, but like real basic is just revenue difference. Revenue decline. If it was more than 20% in any given quarter, and important to note, it's 2020 versus 2019, 2021 versus 2019.
Yeah.
We're ignoring 2020 in the comparisons, knowing that that was a weird year for everybody. So if your revenue in Q1 compared to Q1 of 2019 dropped 20%, then you qualified for that credit. If you got the PPP, you could still get it, but you couldn't use the same wages. So
Right.
I couldn't get the ERTC credit on my wage, or Michelle couldn't get it on my wage and use it against PPP. So Michelle's point of doing a dance, we were really trying to figure out maximizing PPP forgiveness and ERTC usage to make sure everybody's getting as much bang for their buck. And important note on that is that this isn't per se a taxable income, but you have to reduce the wages by the amount of the credit. So it becomes
It's
taxable.
It's taxable. I mean, you don't get a credit for it and get to take a deduction, essentially.
Right.
So it's still great.
Right.
It's still best case scenario.
PPP
It's
allowed
not
us to,
PPP. Well, that was best case scenario.
right, where we got the money, didn't have to pay it back, and
Free
still
money,
got the deduction.
Free money.
Purely, it was
I mean,
pretty free
you
money.
had to, stay open during the pandemic and all those things, but free money.
But that was a big one. And
Mhm.
part of the infrastructure bill that I think President Biden's planning on signing on Monday.
He's busy this weekend.
Yeah, he's busy this weekend. He said he's planning on doing it on Monday. Part of that infrastructure plan, there's two key tax components to it, and one is they've terminated the ERTC credit effective September 30th. So any wages paid after September 30th don't qualify for ERTC. It's still an active plan. So if you had wages, like Michelle saying you hadn't done it, maybe you qualified. Any wages paid between now and January 1 to September 30th of 2021, you could still go back and get the credit.
Yeah.
It's just wages thereafter.
Yes. Party's over on that.
Yeah.
And hopefully you're up 20% from where you were in 2019 anyway, right?
I
Yeah.
hope so.
I hope so. And then they had extended the family and sick leave credits
Mhm.
for people who are having coronavirus-related sick pay that they're paying their employees. You're able to get a credit for that on your
Right.
payroll tax returns. But
Yeah.
that's over as effective with sick pay paid through September 30th, right?
Right. Yeah.
Okay, so that's what we know for sure.
That's for sure.
And you mentioned the new tax laws for what's being signed here shortly,
Correct.
right? There's some other pandemic-related tax issues, right? I mean, so thinking about things that happened in 2021
Mhm.
that we may not have thought of being a tax issue, and one of them is how people started working from home, moving and working in different states,
Mhm.
and employers started paying people in different states, right?
Right.
So you may have to file a tax return that you hadn't planned on filing before, right?
Correct. Yeah.
And I would say for a riveting breakdown of Nexus, for those of you who are able to stick with us through that whole episode, we used Loki and the power of the Nexus to explain what states you pay tax to and what that really looks like. It was riveting.
It was, and we're not shameless at all.
Yeah, go.
Yeah.
Yeah. I mean, we
If-
already talked about it. Just go listen to that.
Yeah.
Yeah.
Where could you find a piece of information that's, engaging and humorous about
Yeah.
economic nexus? I
don't think it's been, I think it's only been done once.
Yeah.
And then another issue that's not just pandemic related or 2021 related, but it was super, super prevalent is fraud. Fraudulent filing of tax returns and able to get people's refunds, fraudulent filing of unemployment claims.
Oh my goodness.
Right? And so, protecting your information, password protecting your documents as you send them to your advisors and your CPAs, and then going the next step further with the IRS filing early.
Yeah.
early and often. No, I'm just kidding. Filing early to make sure that you get the right tax return filed for you for those people who are out there fishing for refunds.
Wasn't the unemployment fraud in the state of Kansas? It wasn't like 680 million
It was, sir.
plus.
Plus.
Oh,
Yeah.
California was absurd. I forgot the number, but I mean, this happens.
Yeah.
It happened to a family member of mine. Someone filed a fraudulent tax return to get the refund. I mean, so don't take it lightly. It's real.
I received an unemployment debit card from both Kansas and North Carolina this year.
North Carolina, huh?
Yeah, I did.
don't pay. I don't
I've
pay
never actually
unemployment
been
for
in
you,
North Carolina.
Carolina.
Never been to North Carolina in my life, but I
Yeah.
got apparently I got some unemployment.
Well, I got my notice that said how much I would get if I was to get fired,
Yeah.
and I'm telling you, I can't live on that. So I gotta clean up this podcast so I don't get the axe, man. But
All right, we got to
that-
monetize this.
Yeah, we can't cut down on Biggie Smalls for the hoodies.
No, honey. Like this is a look. This is a look. Okay, guys.
I think an important thing to note on the we talk about it a little bit in the low key podcast, so go listen to that when it drops.
I thought we were saying drops.
Yeah.
She's wearing the Biggie the hoodie.
Right, I'm feeling it.
Yeah. Boom.
You may be filing taxes in another state.
Mm-hmm.
When you're filing it yourself, sometimes the software doesn't know what it doesn't know, and you end up paying tax in both states, and that's not really the way it works. You should get a credit. Always pay tax in the state in which you're a resident in, and you always pay tax in the state in which you've earned it. But you'll take a credit on your resident tax return for the taxes you paid in another state. So if it's really pretty different, where you end up having to write a big check to Kansas, even though you didn't really work there,
Mm-hmm.
probably the system isn't grabbing the credit from the tax you paid in the other state. So
It happens all the time.
all the time.
All the time.
Yep. And then the infrastructure bill,
Mm-hmm.
the other piece of that is about crypto. And I don't know if we've, know any place else if people have talked about crypto before.
Possibly in a very, it was a Crypt Keeper episode on crypto where don't do the voice, Underwood. You want to do it so bad. But he got to do his crypto voice.
I think the
Crypto voice.
takeaway here, audience, is that we're just carving all sorts of new paths.
No, I mean, crypto, a lot more people are into it in
Yeah.
2021, right?
That's
I mean, it's a thing, it's accessible, and people are doing it. So
Mhm.
it's taxable, kids. This is
It was always headed here. Yeah.
it was always taxable too.
Yeah, well, you know what I mean, though. But like, it's like they're gonna clamp down on it. Is what
They
I mean.
are. What's
Yeah.
in the new infrastructure bill, Chris?
It doesn't speak to the taxation of crypto
Okay,
because, as you said, crypto has always been taxable.
right.
It's just a matter of how it was taxable, what kind of crypto you're talking about. But what it's now putting a lot more emphasis on is reporting. So all the brokers, and that
Mhm.
defines what a broker is, essentially anybody that's facilitating the exchange
Mm-hmm.
of cryptocurrency, they're now going to be required to report the transactions, much like a broker for a financial service agency is required to report the dividends, the capital gains, the interest income that's earned in any given year. They haven't been up to this point of requiring that because it wasn't the defined property that most people were thinking of. So
Gotcha.
you won't necessarily be able to not tell your accountant that you bought and sold cryptocurrency
The
in the year.
IRS is going to know your activity, right?
Right.
And they're going to match it up. It'll take them a year or two, but they're going to match it up because they get that information. Then they're going to send you a notice. So report it and get out ahead of it, right?
Yeah, I hadn't dug too deep, and I'm intrigued as to what the reporting requirements are because there are so many variations to what the taxation of cryptocurrency could be. Whether it's you're a miner and you're receiving compensation, whether you've been paid where you bought cryptocurrency or use cryptocurrency. I think it's going to be intriguing to see how much reporting they're actually going to be required to do,
Yeah.
as opposed to just like a capital gain where you own it and then you sold it and there's a capital gain on it.
Okay, so I'm an individual, and there's not a ton of moves an individual can do, right, to really help manage their tax liability. But there's a few things,
Mm-hmm.
right? So this is for your W-2 employees. These are for your investors. Things that you can do here before the end of the year to help manage your tax liability. So the first is tax loss harvesting. Oh,
Mhm.
that sounds like fun. That's like farming meets taxation, right?
Yeah, this is your and Chris's world right here.
Yeah,
Yeah.
absolutely.
Well,
So
actually, you guys don't have any losses in the trading that you guys. Of
No.
any of the
All
clients.
winners. All winners.
past performance is not indicative of future results. So tax loss harvesting is for people with investment accounts, taxable investment accounts, right? Where they have positions where they have realized capital gains that are going to be taxable, going through your portfolio, looking for possible losses to offset those gains. So positions that you are going to rebalance or do something with different anyway, go ahead and take those losses, do your rebalancing, and take those losses to offset against your gains.
I actually just did some harvesting today. It was painful.
Did you?
Soybeans.
I wish it was soybeans. It was some poor choices earlier in the year.
Poor choices that were screaming red on that little screen that you look at of where my personal investments are. So there's
Right.
some rules with tax loss harvesting that I'm not allowed to explain because I always say it wrong. Wash sales,
Oh,
right?
yes.
So can you
Very
say what a wash
important.
sale is?
Very important rule. Harvest the loss, but you can't buy it back for 30 days.
30 days.
30 days.
What if GameStop goes through the roof, Chris?
I know.
It's the game we play.
Stupid
Yeah,
rules.
Stupid rules. So you can buy another stock,
Correct.
but you can't buy the same stock.
Can't buy the same stock.
Okay.
Right. So you realize the loss,
Yep.
but you don't get to take the loss. It just gets added back into your basis of the stock, your
Yeah.
repurchase stock of the same kind. So if I sold GameStop with $1,000 loss and I bought another $1,000 with it, now my basis is zero.
Still the same. Okay. Well, that's a pisser.
Yeah.
But you can do your rebalancing, and there usually is something that you can move into
Mhm.
that would allow it to be true tax loss harvesting.
Right.
Awesome. Okay, perfect. Retirement planning discussions for individuals. Going through looking at your most recent W-2, make sure you're maxing out your employer-sponsored plan if you have a 401k or the like. Also making sure that you're taking advantage of the IRAs
Mhm.
that you possibly could. Those rules are really complex because
Right.
they're also based upon your overall adjusted gross income. So it's like you don't know that you could do it until you did it. So talk to your financial planner and your advisor, making sure that you're maxing out all of the retirement contributions that you have options for.
And HSAs.
And HSAs.
Don't forget those.
I keep telling people HSAs are wonderful.
They're-
Pre-tax dollars that you can turn around and invest.
Yep.
I mean, it's basically you're buying mutual funds for a 20% discount.
Or saving it for healthcare needs.
Or buying mutual funds at a 20% discount.
Yeah, I think a lot of people misunderstand what the HSA really
Yeah.
is and what it's for. I think they think that in putting it in to use it for the healthcare costs of that year,
Right.
and then you can really build those up. And there's a lot of getting to estate planning, a lot of benefits of estate planning rules with HSAs that people don't quite realize that how much of an impact that can make on their taxes.
And if I didn't explain it well, is that after you hit a certain threshold in an HSA, you can invest the money. So that's what I was talking about, buying the mutual funds. So then you can grow it at a discount, if you will. And then if you have a medical need, you're just growing your pile to pull from.
Yeah.
And one thing that people sometimes forget is that you can make that contribution up to April 15th or the tax filing deadline. We're going back to April 15th this year, I'm pretty sure.
Promise.
I'm pretty sure. There's
Okay.
no compelling reason right now to extend it past April 15th. But the world could change.
The world could change.
But you can make that contribution up to the tax filing deadline, and even if you're making contributions through your W-2 throughout the entire year,
Mm-hmm.
you don't have to do that through payroll. You can just write you can write that third-party administrator a check and send it in by April 15th.
And you used to not be able to roll over, but a certain amount, you can roll over whatever's left over. It can keep growing and growing and growing. Yeah.
Right. That's a good point. That's a
Thank you,
great
Cohort.
tax-
I just impressed Cohort, I think.
PJ just wrote down that he finally made a good point at the last episode of season 1
Yeah. Of the whole year.
of the whole year.
Yeah.
Yeah. He flagged it. I watched him.
Yeah.
Good point. No, thank you. It was awesome.
Yeah,
And we talked a little bit about estate planning there. We mentioned
Yeah.
that there. I don't want to talk too much about estate planning. another shameless plug, Knives Out episode that is actually dropped.
So really, this year-end episode is us just talking about how great our episodes were throughout
Yeah.
the year.
I really enjoyed Knives Out, just saying. But like, and there's more coming. That's to the
Yeah.
point of estate planning there. We know with no additional legislation that the lifetime exclusion rules will be changing effective January 1st, 2026.
Mhm.
Just period. But in the Build Back Better plan that may or may not ever make it all the way through, there was at one point some pretty significant changes to estate taxes. So just keep your ears open. We'll keep our ears open and let you guys know when those things change. But there might be some pretty significant changes to estate planning if some of these acts make it through Congress.
Yeah, really impactful tax issues.
All right, so
And some Roth IRA issues.
yeah,
There's
trust
huge
issues.
there-
They're going to change some trusts.
Yeah, the Build Back Better has big impacts, and I think one thing to note for this moment before we move on to businesses is
Yeah.
a lot of that stuff becomes effective December 31st. But what there is a stipulation in there that there's some capital gain rule changes for individuals, and if the Build Back Better does pass, whether today, tomorrow, January 10th,
Always.
2022. Then those capital gain rules for sure would be effective September 13th of 2021. So we would have January 1 through September 13th would be one capital gain rule, and September 14th to the end of the year would be a different capital gain rule.
You know what I heard in that? All the reasons why the tax deadline will probably get moved from April 15th. Because, like, the IRS has to figure out how to do the form. The investment companies have to figure out how to report that to us. So let's just see. There's some stuff. There's a lot of important stuff in that. So please watch that for the tax stuff as well.
Yeah, if we get something, we're talking about this might be end of season 1, but we're talking about trying to drop something about the Build Back Better plan too.
I'm just hoping for the billionaires tax that's in the one of the iterations of the Build Back Better plan. That just sounds like a lot of fun to watch.
It's going to be painful on me, just as,
You know, you're right, Chris. I was just thinking about how that would impact you directly.
You're gonna have
Yeah.
to sell one of the yachts.
Yep.
How Twitter polls, should he or should he not sell his 10% stake in his pontoon boat?
I started harvesting. So let me pull up my phone and get my little app out and harvest a few more losses.
I'm sorry, we're funny. We think we're funny. Okay, what should businesses do to help reduce their tax liability? My husband said he's going to go buy a
Yeah.
bunch of shit. So I said, that's not how that doesn't work.
I feel like you and Jerry have this conversation often.
Whenever he wants to buy
Buy
something.
tools, right?
Mhm,
Yeah,
mhm,
yeah.
mhm.
I think it's very similar to the individuals where there are things we can do. So much of it is about spending money. And when you said that it's hard to do anything from an individual's perspective anymore, and that's a lot because of how much they increase the standard deduction.
Yeah.
We used to be able to say, well, make another contribution and that has an immediate impact. And now we don't, because the standard deduction is so high. They just adjusted it for inflation to $25,100 this next
How am I
year.
going to remember that number?
Yeah, it's an odd number.
Balls. I'm
So
going with 25K.
So it's really hard to start making those strategic moves that aren't the retirement, that aren't like above the line numbers.
Yeah.
And then looking at what the true cash flow aspect of that is. I think that's the same thing for the businesses. We can always do low hanging fruit, which is if you think your income's going to be lower next year, you defer revenue into the subsequent year, or accelerate expenses from last year or next year that you know you're going to need to do, pull them into this year. If your income's going to be higher next year, maybe you're going to do some billing this year that you weren't planning on doing. Maybe defer some of those expenses into the next year. Maybe there's some retirement plan. Again, depending on where you think your profit's going to be, maybe you want to make a profit sharing contribution for your employees. Maybe you want to do some year-end bonuses. But that's, again, you have to start managing cash flow too and see what the overall impact of the business is.
Yeah, it typically takes cash to get the deduction.
Right.
You know, one of the ways that that we have helped some of our clients is by really doing an analysis as it relates to the accounting method on which they pay tax.
Correct.
Whether they file their activities for their business on a cash basis, so what came in and went out, or on an accrual basis when they earned it and when they versus when they paid it. So, doing some of that planning and those kinds of discussions. But other than that, and maybe engineering when you use your net operating losses and those other kinds of discussions you can have with your accountant. Everything else is very cash motivated, right, Chris?
Right. Absolutely.
So right now, there's still bonus depreciation
Correct.
for something that has a life less than
15?
15 years.
It's 15.
So bonus depreciation means that for those types of assets, when you buy it, you get to write 100% off in that period. So that's still active for 2021.
Yeah.
Till, I'm not going to say the year. We're going to just take it year by year, so I don't biff that up. Okay.
Oh, we got a big tax plan that's potentially coming out
That's
too.
right. So I'll speak for what we know today, right?
Yeah.
And then Chris said, with the profit sharing contributions, take a look at your 401ks, as we're all trying to retain and attract employees, taking to say, okay, what am I matching? What does that look like? Do I want to add a discretionary profit sharing contribution option to my plan that allows you to put money in, get a deduction on the business and put it into the retirement plan for your employees? So that's pretty attractive because it also is a good employee benefit in addition to a great tax deduction. So a 2-for-1 deal, right, on that. So looking at your retirement plans to see how that really fits.
Right.
I went out to lunch today and charged it to the firm because I remembered, and I did, that business meals are 100% deductible, right?
Yep.
I didn't get that invite.
Well, eating our bonus.
Right. She had to manage the cash flow pass. Here's the deduction. Here's how much cash I can get back.
Okay, so then what else?
I think the most important thing, and correct me if I'm wrong, there's
We
a lot
always
there's
do.
there's a lot of details. There's a lot of nuance to this. It's always changing, always evolving. So again, planning and communicating with your trusted advisors. It's an ongoing conversation, and just make sure that you're doing what you should do to take advantage of everything out there.
Yeah, I agree. I mean, we're just in tax projection heaven right now. I think Karen in our office doesn't want to get another email from me because I'm asking her for yet another projection.
Yeah.
But us being able to really know what the impact might look like so you can make informed decisions, because maybe you don't need the truck this year because it's not going to have that significant of an impact on you.
And we as advisors have very few levers we can pull after year end.
Yeah, very true.
There's a few things that we can do and we can help with, talking about the deadline as it relates to HSA contributions and some IRAs, but some of those big dollar numbers, we need to have that figured out now, so that we can make sure that we minimize, right size your tax liability for the situation that you're currently in.
And I think this year's unique in that typically we were able to just go out and get something and place it in service, like a new truck or a fleet of vehicles, whatever it is. And with the supply chain issues, we're having a much more difficult time just ordering something and having it, because the important piece being it's placed in service before the end of the year. Can't just order it and get the depreciation.
You have to drive it around the block.
Yeah, for sure. Gotta sit in it.
On that note, we did a pretty good job. That wasn't too boring.
I hope not.
No, I don't think so. I thought there was some fun stuff in there, but that is it for today's episode. The last episode of season 1 of Trust Us, We're Professionals. But good news, kiddos. We just renewed ourselves for season 2.
Surprise, Brian. We did season 2.
That's
we agreed
right.
to
So-
it.
It's up to my spending threshold.
All right, so thank you for joining us. We're really excited. If you ever have any financial questions, you can always reach out through our website, www.ssccpas.com, or email us at podcast@ssccpas.com. So much fun. Chris, Michelle, I will see you next year.
Is that a PTO request?
I'm out.
Bye.
This podcast was recorded and is being made available by SSC Solutions, Inc., together with its affiliates and its employees, SSC, solely for informational purposes. SSC is not providing or undertaking to provide any financial, economic, legal, accounting, tax, or any other advice in or by virtue of this podcast. The information, statements, comments, views, and opinions provided in this podcast are general in nature, and such information, statements, comments, views, and opinions in the receipt of this podcast by any listener are not intended to be and should not be construed as the provision of investment advice by SSC, that listener, or generally, and do not result in any listener being considered a client or customer of SSC. The information, statements, comments, views, and opinions expressed in this podcast do not constitute and should not be construed as an offer to buy or sell any securities or to make any investment course of action. The information, statements, comments, views, and opinions expressed or provided in this podcast, including by speakers who are not officers, employees, or agents of SSC, are not necessarily those of SSC and may not be current. SSC does not make any representation or warranty as to the accuracy or completeness of any of the information, statements, comments, views, or opinions contained in this podcast, and any liability thereof, including in respect of direct, indirect, or consequential loss or damage of any kind whatsoever, is expressly disclaimed. SSC does not undertake any obligation whatsoever to provide any form of update, amendment, change, or correction to any of this information, statements, comments, views, or opinions set forth in this podcast. No part of this podcast may, without SSC Solutions Inc.'s prior written consent, be reproduced, redistributed, published, copied, or duplicated in any form by any means.